Good afternoon, this is Stewart Solaka with Chicago Stock Trading here at the studios of Mr. Top Step, and today we're going to be looking quickly at a couple of markets, the equities, ES, NASDAQ, and the E-mini mid-caps. Today we saw the S&P open above 2,000, make a run at the Globex highs of 2011, and get rejected a point short at 2010. The intraday vol window came out at 2008.25. The market held above that to establish a bullish intraday bias, luring in longs above that. And by failing to take out the 2011 high, we saw the market drift back lower by the weakness seen in the NASDAQ. So the market came back to test this reversal window at 2,003/4. Once we held below that and reversed the intraday bias, those longs above the upper vol window got flushed out, and we saw that Mr. Top Step 10 handle roll come all the way down to 1990.75. So if we look at the 60-minute chart on the cash S&P, we have the market has been in a sideways range. Last week we had a failed breakdown on 87.50 before recovering and trading back above 2,000. This week the market has tried to break out above 2004. Yesterday we opened above 2004 and was rejected down to 96. Today we opened at 2,000. We made a run above 2004 and we were rejected at 2010. And we're seeing a move now below 92.75, which was the recent low prior to breaking above 2004. So going forward for tomorrow, what bears need to be looking for is if they can open the market below 92.75. A cash open below 92.75 gives room to leave these buyers above this range trapped and attempt to target 87.50. So if we do look at the NASDAQ daily chart, on Tuesday we had highs of 40.96. We traded in a very tight range. Wednesday we broke above 4,100 to run stops, get longs in, and then what happened? We completely rejected that and we fell below Tuesday's lows. That set up a failed breakout where today we retested 4,100 and it was rejected. So what that shows us is buyers above 4,100 are now trapped in the market. We can see is now putting pressure against the recent 40.54 lows. A breach of 40.54 confirms a failed breakout on the daily charts and gives room for the market to pull down and test major support down at 39.16. If we look at the mid-caps, we're seeing the same thing. The mid-caps broke this year's highs right above 14.50, failed to hold, and we're now seeing a rejection where today we retested 14.45, which was yesterday's ledge, and the market rejected that. And if we look at a 60-minute chart, you'll see a head and shoulders where today's highs developed that right shoulder, and now we're back below the two-day lows. So this two-day lows is very important. If the bears continue to press and attempt to expand this head and shoulders, it gives room down to 14.20. A break of 14.22 confirms the breakout above 14.50 was a failure and gives room for the mid-cap to trade lower. On the S&P daily, we had the reversal above 1977 to reverse that V-shaped bottom, and the bear trap set below 1932. This has given room up to test breaking through 2000, and most recently we've been hitting this 2011 highs, where yesterday we saw a intraday reversal down. Today we attempted to retest those highs and the market rejected, and we're seeing a pullback below yesterday's lows of 1996. So a close below yesterday's lows of 96 sets that level as new minor resistance up to 2001 for sellers to attempt to defend today's highs. And it's also going to give buyers their range that they need to break through to continue the momentum as it develops a new barrier for them to work through. Everybody's looking for this 2025 level. That's 100% fib extension, and so far we've stopped at 2011 and we've gone into a little bit of a breakdown. So on the S&P, if we do see this previous low of 1987 taken out and a close below that, that sets up a bearish signal with rallies up to the 96 level to be defended on the short side, and it gives room for the market to at least pull back and try to test that reversal window at 1977, followed by major support at 1960, which was old resistance before gapping above that. So those are the levels we'll be looking at, and see you next time. Have a good one.